Welcome to the Stay Informed podcast. I'm Tom Oscherwitz. My other co-host, Jessica Gonzalez, is sitting this episode out, but you're in luck today. Today is a very, very special episode. With the recent Supreme Court decision validating the constitutionality of the CFPB, we are focusing on what to expect from the CFPB in 2024. And joining me are two prominent alumni from the Bureau who I also count as friends, Gary Stein of 99 FinTech and Nora Rigby of the Akerman law firm. Combined, this group has over 20 years of experience at the Bureau. Gary, Nora, welcome to the podcast.
Hey, Tom. Thanks for having us.
Hey, Tom. Yeah, thanks.
Let's just do some brief introductions. Gary, starting with you first. Can you share your background at the CFPB and what you're up to today?
Sure. So broadly, I've been in banking and financial services for about 35 years. Worked as a banker and as a consultant for about 20 years prior to joining the Bureau, and then joined really to lead policy on deposits and overdraft, but had the pleasure of working with several folks there and spent a lot of time focused on payments, consumer data, unsecured credit, and remittances as well.
And Nora, tell us a little bit about your background.
Sure. I worked at the CFPB for about 10 years, all of it in the Office of Regulations, which is the office that drafts all the regulations at the Bureau and also interprets the regulations for other parts of the Bureau when they're sort of tough, difficult questions. I had progressively more senior roles in the Office of Regulations. The last one was Chief of Staff and Senior Counsel in that office. Worked on a variety of issues, including arbitration and lending and student loans, all sorts of things. I've been in private practice for the past 2 years at Akerman, and I represent a variety of sort of smaller fintechs, larger banks, money transmitters, sort of you name it, some associations, most of which have some dealing with the CFPB, but also with respect to state licensing and state agencies as well.
You know, before we start getting to the meat of the podcast, it's rare to get a bunch of insiders in the room at one time. For folks who don't know much about the Bureau, is there sort of any sort of inside experience or things that you might find surprising? Just to give you my own start off, one thing that people I don't think know about the Bureau is that while it has a single director, it has a lot of different divisions. I almost describe it as Articles of Confederation, where there's different parts. There's enforcement, there's supervision, there's regs, and they all kind of wrestle with each other to work on policy. So I just think that's one little insight. Gary, Nora, any sort of special memories or thoughts or insights about the Bureau from being an insider?
I think a lot of people might be surprised that the attitudes and interests of everybody that works at the Bureau don't automatically fall in line with the president every 4 years. And in fact, we had, I think, to your point, Tom, not only different interests from roles, but different interests and viewpoints and how to approach the market, what to do when we see potential consumer harm and how to address it. And so it may sound like, at least over the time that the three of us were there, I won't comment as much on the current administration until we get into the meat of the call. There's a lot more debate than probably people expect in diverse perspectives.
Yeah, I would agree with that. I would say the one thing people might find surprising, and maybe this is just sort of the clients that I advise that are sort of very heavily regulated by the CFPB and sort of typically, I think, very afraid of the CFPB, is that it's not quite as omnipotent and as sort of coordinated as everyone thinks. I think they assume that there's some intent. If the rule takes a while to come out, after the comment period closes, they think it's some nefarious thing is happening, and in fact, it's just there's a lot of work to be done, and it takes a while. And why hasn't this thing been published in the Federal Register yet? There's a million silly administrative bureaucratic reasons for things like that, and it's not always something intentional or scary going on behind the scenes.
There you have it, folks. From the insider's perspective, when we planned this podcast, we didn't realize that there would actually be a Supreme Court decision that would come just around the corner. And just to level set, guess what? There was a Supreme Court decision on the CFPB. Nora, perhaps you could just give us a little summary of what happened, and I'd love to sort of just share observations after we just level set on what the facts are.
Sure. So what happened is that there was a lawsuit about ostensibly about the CFPB's payday lending rule. That was the context of the argument, but the issue before the Supreme Court was not limited to that particular rule. It was about whether the agency as a whole, the CFPB as a whole, is constitutionally funded. And the argument had to do with the appropriations clause of the Constitution, pretty arcane topic. And the argument was that the CFPB was not constitutionally funded because it was not appropriated by Congress in the way that is required in the Constitution. Without going into the weeds of that, 7 of the justices held that the Bureau is in fact constitutionally funded, so rejected the argument that it was unconstitutional. So that's the basics.
So, my experience, and I'm curious, this is for you, Gary, when I started working at the Bureau back in 2011, it was almost like a daily ritual of somebody claiming that the Bureau was unconstitutional one way or the other, and the fate of the Bureau always seemed to be waiting for the next decision. How do you think this might affect both, how the internal folks see the Bureau and externally? Is this just another bump of the road, or is this more significant?
I think it's pretty significant. I think, by the way, I should have mentioned in the beginning, when Tom and I joined in 2011, we shared an office. So there's another fun fact for all of our podcast listeners. Right now, there's a lot of regulation and other action that comes out from the Bureau that I think obviously affects market stakeholders pretty substantially. And, these stakeholders have challenged the Bureau's rulemaking and other actions. And, this method, as Nora said, was used to challenge the payday rule by a trade association. It really starts to run out of all the structural issues in Congress and how Congress set up the Bureau, and really drives the debates about what the Bureau's done and the evidence that they've collected and used to substantiate any rules. It takes it much more to a content-focused discussion. This particular argument was used to hold up the implementation of 3 rulemakings. It's the payday rule, which went through some other machinations in the prior administration, as well as the 1071, which is a small business data collection rule, and most recently the credit card late fee rule. And it's not like this is the last obstacle. You pull this plug out and now those rules are all going into effect, although the Bureau has indicated that the small business data collection rule, the countdown is going. Look for industry to challenge now on the merits and the evidence that the Bureau has used on these rules, I think, going forward.
Nora?
Agreed. I agree with all that. I think in the short term, I suspect the biggest impact will be on the Bureau's enforcement, because there's so many enforcement cases I think that have been held up by the looming prospect of the agency being held unconstitutional. Because anytime the Bureau brings an enforcement action, the immediate response is, well, the agency's unconstitutional. We can't go forward on this case. Let's wait and see what happens in the Supreme Court. That's been happening in a bunch of individual cases. And I think over time, the Bureau has not, and I think there's some data on this, the Bureau has not brought that many enforcement cases in the last couple of years. And that could be why the prospect of this argument out there, in this case out there, sort of chilled some enforcement litigation. But the Bureau has now been on a hiring spree, particularly in the Office of Enforcement. And even since the decision has come out, I believe the Bureau has brought 2 contested enforcement cases, meaning not settlements that people are going to litigate and fight against. So I think that's going to be the biggest short-term impact, is more enforcement cases.
Yeah, I think that's a great point. And I don't know if I'm stealing one of my key nuggets for the end of the podcast, but I think regardless of what happens in November, I think that's something that will enable the flow of enforcement actions under any administration. So far, I think all directors have recognized that one of the most measurable ways for them to demonstrate their impact is through enforcement, because you can count it in dollars. And so what Nora is talking about isn't something that's only going to go until if Trump wins the election. I think it'll have implications beyond that.
Next point, which is great observation. One thing before we get into, what's next, I want to talk a little bit about the rules. But before we do that, I think it'd probably be a good idea to talk about an election year topic that is relatively new, which is the Congressional Review Act. And the reason why that's important is because, I'll let Nora explain. Why is the Congressional Review Act relevant to what's going on in the rules and the next steps of the activity of the CFPB?
Sure. So the Congressional Review Act is a statute. It is not very old as statutes go. It's like 15 to 20 years old, which permits Congress to pass what's called a resolution of disapproval of any regulation finalized by any federal agency. And so this can happen at any time, but it really only matters when the presidency changes from one party to another, because right now, if you have a Democratic President Biden and you have Democratic heads of agencies, you assume you're going to have rules that President Biden would be in agreement with, and he would veto if there was any resolution of disapproval, any of the regulations that come out of his own administration. So if we get a Trump presidency again, there is the possibility that any regulation passed at the end of the Biden administration could be disapproved by Congress. So that is why it matters.
And just to sort of clarify, my understanding of the Congressional Review Act is that the president can veto a resolution of disapproval. So therefore, if Biden was the president, he would likely affirm what his agency done. So it really depends on the change of the presidency. Is that correct?
Exactly, 100%. Yeah, it really is only relevant when there's a change in the president.
Right, but Nora, there's also, not to go too far on this, but there's a limited time window, right, for the CRA?
Correct. So so it's always that within 60 legislative days of when a regulation is passed is the window to permit Congress to disapprove it. It's complicated to count legislative days because it's a moving target that depends on when Congress is in session, which they can change at any time. Basically, any regulation that is finalized between essentially now and the end of the year could be up for disapproval pursuant to the CRA if Trump is elected.
Let's get down to the rules. I mean, maybe, Gary, if you could sort of update us on what some of the rules are that are in play right now and what's being held up, and then we can talk a little bit about them.
Sure. So I think one of the biggest ones that I actually worked on personally prior to leaving the Bureau is Section 1033, personal data rights. You might think of it as open banking, consumer access to their financial data. And this is, actually, because it's a section, that means it's part of the statute that created the Bureau, which means that Congress, when they created the Bureau over 10 years ago, had instructed the Bureau to write a rule to essentially ensure that consumers have electronic access to account data. And there may have been some notion early on that this was to mean that consumers could take their account histories from a checking account and move providers kind of willy-nilly. That's not really realistic because payments aren't all instantaneous at this point in time. So to change accounts, you still have to turn off your payment flow, have some money, and move it over. But we've seen over the last dozen years or so, all kinds of use cases where consumers now, not directly, but through a third-party app, might be tapping into their account information to help them budget, to help them and plan, to accelerate the application process for maybe an auto loan or a mortgage loan by bringing in, information that would help qualify them. It helps then file customers look at things like utility payments when they don't have credit scores. And increasingly, it's also used to help initiate payments by helping to validate that, hey, that's Tom Oscherwitz's account. He's got money in there, and this is a valid connection. To date, though, there hasn't been a rule in place that governs how all that works, and a lot of it's done through screen scraping and sharing of credentials. And the Bureau has gone through a pretty methodical process. Again, I had a front seat at that, helping to write the Consumers Financial Protection Principles, as well as the RFI and ANPR that went out. And then last fall, they actually proposed a rule on this. And the rule would do a lot of things, but importantly for this audience, it would restrict how data is shared and who has to share it, but it pertains only to checking account, digital wallet, and credit card providers. So auto loan providers, for example, would not immediately be required to share in the manner that the rule dictates, which includes things like making all data available, having response times, and not in charging a fee for data access, and indirectly, basically, in parts on these data providers, an obligation to evaluate the authenticity and security certification of who's requesting, plus the authorization, and making sure that that's right. So there's a lot to get ready there. The Bureau has kind of cheekily introduced a lot of staggered implementation timelines that lots of people love and hate, as you can imagine. Nobody completely loves any rule that the Bureau puts out generally, and does a number of other things. I think a big issue for this is because the Bureau limited the scope of types of account providers to those three. How does this play out in the auto, mortgage, investment world, which, and insurance, and those aren't even products that the Bureau regulates? I think that's a very open question. How it plays out while certain institutions are required to comply immediately and others have 2 years, it's going to be a pretty uneven world out there, as we can see.
Question for you. I was just going to ask this for you and Nora too. Okay, Congressional Review Act, yay or nay? Is this at risk?
My thinking is no, and TBD, right? But it's a relatively small group of people who are covered. The covered data providers are just those 3 areas that Gary was talking about. And I think it's a political question. So this is really actually not my area of expertise. This is more you need to ask a lobbyist about this, but I just am not sure that there's a constituency that is large enough that could sort of gin up the political power and the political sort of outrage over something like this. It just feels very technical and sort of not the type of thing that you're going to be able to get members to pay attention to, or the kind of thing that these banks, the covered providers, really want to spend their political capital on, because ultimately I'm not sure that I don't know that this rule is actually all that harmful for them. So to me, I think it's probably not at risk.
I would also guess no. I mean, make no bones about it. There are some serious concerns about this. Right now, with the types of products that are included, if a consumer has an issue with their account, they see some unauthorized activity on it, the laws are, I think, pretty cleverly written to give the consumer one throat to choke. You go back to your account provider. Now, if you're sharing information with, I authorize some merchant or some other company to use it, and there's a data breach there, and now that's affected my account, how does my account provider go back and get reimbursed from those other entities? That is not solved here. There's no liability sharing framework or private network that's emerged to clearly do that. And and there's other issues about how this might open floodgates on types of payments and consumers' ability to prevent authorized payments, and that's a nerdy rabbit hole we could get down into. But I would agree. I think there's an interesting development we were talking about prior to the podcast, which is the Bureau released an interpretive rule that classifies pay in full, buy now, pay later loans as credit cards as a means to ensure that those providers give consumers credit card equivalent dispute resolution rights. So if you use a pay in full to pay for something, say at a store, and it's not what you thought you were getting, you would now have a TILA-like ability to go back to basically the credit provider and say, I don't want to pay for this. But in the world of 1033, what the Bureau has essentially done is expanded the scope of the 1033 rulemaking to include a whole new class of products without reproposing 1033. So I think the Administrative Procedure Act enthusiasts might have a little skin crawl there, but I'm curious what your thought is on that, Nora.
Sure. I mean, I think I agree with you. What the CFPB did, again, and this is probably too nerdy, too academic, but so stop me, Tom, if you want me to stop. But what the CFPB did was release an interpretive rule where they essentially said, we don't have to do notice and comment here. We don't have to propose. We're not amending the actual regulation. Instead, we are interpreting the existing regulation, which in this case is Regulation Z, which implements TILA. And we're saying that under the existing regulation, these types of buy now, pay later loans are in fact credit cards covered by the existing regulation, which then as a result puts a lot of existing consumer protections and sort of a regulatory landscape on these loans that most providers did not think applied to them. And so then as it's not just that 1033 is now expanded, it's a whole scope of regulations are now applicable.
That's true. I mean, loans. Rules that are already in the books, I mean, you could take that lens. It's just interesting when one is being proposed and a comment period is ended. But we're probably
just one comment I would make here, guys, is that just also reminds me we are looking at this is 5 months before the election, and the Bureau is still proposing interpretive rules. And this feels to me like a agency that's going to be aggressive in pushing the limit till the last day it has the ability to push the limit. So I think that's something for people to be aware of.
Oh, 100%. I mean, this leadership of the Bureau has been very aggressive in putting out interpretive rules, administrative opinions, all sorts of these kind of non-notice and comment rules, in ways to interpret the regulations that announce relatively novel theories and new concepts without notice and comment rulemaking. And so there is a lot of question about how valid all of those interpretive rules are, and whether companies actually have to follow them, and whether they have any legal force, and also importantly whether they will survive in a new agency if there is a different Republican director who can just issue the next day another interpretive rule walking all of these things back.
Yeah, I think that's a good point. Sorry, Tom, I was just going to say, the less deliberate the action, the easier it is to unwind it.
100%.
Just to give folks a sort of, I would call a broader brush of all the rules that are in play right now, I thought it'd be useful just to give like an overview. And one point I would make also just in light of the election is that there has been an effort by the Biden administration writ large to focus on something called junk fees. And the idea that there's a lot of different activities that businesses do where there's some concern about whether or not consumers are getting value for it. And the administration and agency after agency that's been working on this. In the airline industry, there was recent rules that came out. There's issues. There's something called the CARS rule at the FTC. In fact, there's a number of rules also at the CFPB, which one could argue fit into the rubric of junk fees. So maybe, Nora, if I could just lift a couple rules here, if you could just quickly describe them, or you, Gary.
Sure.
Let's start with Nora. Just to let people know what the landscape is and what the rules are to escape in the next couple months. So I'm thinking about overdraft fees, credit card penalty fees, Fair Credit Reporting Act rulemaking. Describe what are some of the other rules that are out there, Nora, if you could, just that are.
Sure. So I'll go to a few other ones. So you mentioned those three. If there's one that has to do with supervising larger participants in the payments market, which basically would mean that the CFPB has the authority to go in and examine certain payments providers like they do banks, even though these are not banks. So that would be sort of not imposing any particular new regulations on them, but just giving the CFPB the authority to go in and supervise, do an examination on a regular basis and see if they're complying with the law. There's another one that has to do with NSF fees, which is insufficient funds fees, that sometimes if you try to write a check or do a payment from your check card, and you don't have enough money in your account to cover that, there is sometimes banks will impose a fee for that, and the CFPB has proposed a rule to prohibit those fees in certain circumstances.
So the things that fall under, junk fees is, suggest that these are non-value added services for things, right? And so two of the ones that the Bureau has extended the concept of junk fees to are, like you said, checking account overdraft, and credit card late fees, right? And ironically, both of those pertain to penalties, but they also pertain to consumer credit and liquidity. In the case of overdraft, the Bureau would effectively classify overdraft fees as a finance charge, which means that the concept of overdraft would become TILA credit, and they would impose a cap on that. And the implication there is that consumers that are getting hit with a lot of overdraft fees are going to hit with a lot fewer overdrafts. That sounds great, right? Except for that the Bureau's own research suggests that the majority of frequent overdrafters are largely subprime consumers that have very little open to buy on their credit cards. And which that tells you that while some of those overdraft fees are nuisance fees, many of them, consumers were using them even if they wasn't their really preferred method as a means of liquidity. So if you're a subprime credit card lender, and now all of a sudden overdraft fees are down to $3, banks aren't going to make that liquidity as accessible as it is today. And that means that delinquencies could go up. We could see that group of consumers and those borrowers, their credit scores decline. So I think that's one thing for auto lenders to be wary of. Similarly with credit card late fees. That rule would impose an $8 cap essentially on all credit card late fees. And while that is a penalty, it's also a way for sloppy payers and people that don't have enough money to pay their card on a regular basis, not only to drive behavior, but to make up for the credit risk they bring. That fee is reduced, then credit extensions to those customers that are frequently late are likely to be constricted. And again, that has implications for other people that are lending to that audience.
Absolutely awesome points, Gary. Nora, I don't know if you want to have anything to add there, or
the only thing I was going to say about those two things is to your question about CRA and whether those particular rules that Gary mentioned, the credit card late fees and overdraft fees, are at risk of being disapproved under the CRA. The credit card late fees, no, just because of the timing. The final rule there came out in March. And so I think no matter how you calculate the legislative days, there's no risk that the election would have any impact on that one. So that one, although what will have an impact is litigation. And so that one has already been, there's already trade groups suing for that one. And I think there are some decent arguments about whether the CFPB actually had the authority to do what they did, capping the late fees, and whether they actually relied on good data to come up with the $8 limit on credit card late fees. I think there are some pretty decent arguments there that they did not. And that will be the issue there, not the CRA. On the other one, on overdraft, that rule has only been proposed. It was proposed and the comments closed in April. So I suspect the CFPB will try to finalize that rule before the end of this year. And I think that one is a pretty good candidate to get the political, buy-in on the Hill for people to reject that rule and pass the resolution of disapproval. So I think that one's one to look for on CRA.
So I want to talk a little bit, I know we don't have a ton of time, but I want to talk a little bit about the soft powers of the CFPB and a new administration to roll something back. And so what I'm thinking about here is either from a regulatory perspective, you have a new rule, but you slow roll it, you delay the implementation date. And then secondly, as Gary so aptly pointed out, the notion that the things that are interpretive, the things that are more discretionary, how might a change in administration affect some of the things we're talking about? I'll just start out with one, which is there's an auto data collection rule that's going, not a rule, but a information request that was made by the CFPB that went to OMB to for Privacy Act reasons. That's the kind of thing where if a new administration said, hey, I don't want to collect the data, they could just stop it and it's done. So I'm just curious from your perspective, let's talk about a little bit about some of the softer powers. If I have a CFPB rulemaking and I'm the new head of the CFPB, what can I do to slow its rollout? Or can I do anything?
Well,
yeah, you could do a lot.
You can do a lot. I mean, so there's an example. I mean, under the Trump administration, under Rich Cordray and Obama, right before Rich stepped down, they put out the payday lending rule. Under the Trump administration, the Bureau put out another rule to basically counter and invalidate the research that was used to substantiate the ability to pay the underwriting provisions. And one rule we talked about, the overdraft rule, I think we could very well see that one element of the overdraft rule is it is restricted only to institutions 10 billion and above, as if consumer harm isn't dictated to what's done to a consumer, it's dictated by who does it. Well, that seems like a pretty shaky argument, right? So if Congress didn't repeal that rule, and to Nora's point, it's not finalized, I think a new administration could easily unwind that one, maybe on that basis. Although there's a lot of technicalities you have to get into.
Can I interject though, which is to say, yes. Okay, so you asked about soft power. Gary's talking about rolling back.
That's more hard power, I guess.
Notice and it's fine. We can argue about soft power or hard power, but he's talking about rolling back notice and comment rulemaking, which is, even though the Trump administration they did that with respect to the payday rule, there is still ongoing litigation about that. It is not at all clear that a subsequent administration has I mean, they have the ability to try to roll it back with notice and comment rulemaking. It is not at all clear that that's going to withstand judicial scrutiny, if you ask me, because that's entirely exactly what I would argue the APA is designed to prevent. That is not what notice and comment rulemaking is supposed to be. So I am not sure that even that Trump administration rollback of the payday rule will withstand litigation. That said, I think until that is, that's going to take many years to play out. I think subsequent administrations will probably do that. Much easier to roll back are advisory opinions, interpretive rules, any of the sort of rulemaking attempts that are really they're almost entirely bully pulpit. They have very little legal effect. They are just the CFPB announcing its view of existing regulations or its view of an existing statute. That can immediately change and have the opposite legal impact as soon as there's a new director.
And Nora, just along those lines, I mean, one thing that you or someone was meant, I think it was you who said that, hey, almost every litigation for the last couple of years has had some sort of the CFPB is unconstitutional. Is now the new playbook? Delay, hope there's a new administration and then maybe the enforcement action will go away? Or is that?
100%. Yeah, absolutely. I mean, that's probably, that is exactly why these people were delaying until the Supreme Court decision, came out. Of course, any kind of delay at this point close to an election, you're going to hope that there's a different director, and then the enforcement actions could all be, paused or withdrawn for sure.
Guys, we've covered an incredible amount of material, and I can say honestly, even as somebody who's spent so much time in this, learned so much from you guys both in today's conversation. Before we have a couple wrap-up questions, I want to say, is there anything that a listener to this podcast might want to know about the next couple of months that we might want to expect from the CFPB that we haven't covered yet? Have I left anything out?
Well, one thing you mentioned briefly, Tom, is the Fair Credit Reporting Act. The Bureau has on their regulatory agenda that they will be proposing a rule under the FCRA related to data brokers. They held a SABRIFA, a small business meeting on this back in October, which is a process that the Bureau is required to go through prior to proposing a rule that might impact small entities. And I just say one of the things that's speculated to be covered in that rule would be the restriction of using credit header data, which and imposing Consumer Reporting Agency restrictions on companies that do that. And I think for this audience, the implication is that some of the servicers that they're using to verify the identities of borrowers could be implicated by that. And the downstream effect could be an increase in the cost of KYC services, or a push to use documentary methods like taking photos of driver's licenses in lieu of doing this electronically through data lookups. And that would have experiential implications for those providers. So I just wanted to throw that out there as well.
And I'm sure most people know, but just in case you don't, KYC stands for Know Your Customer.
Yes, thank you.
I would caution that one is very, very early stages. And I believe the director has said that he expects a proposal on that by the end of 2024, which means that, there's no way that this could possibly be finished before the election and before we get a new president. So if we do get a Trump presidency, that rule almost, there's no way it will look like what it's currently described.
I think Director Chopra's comment said that the rule is forthcoming. There were publications that tried to look into his words and pick out a month or time of year, and he never said anything unless, there was another comment that was off the record or something. The regulatory agenda said spring. This is one of those that I think always felt like it's 4 weeks away, but your point, I couldn't agree with more. At any point, at this time, like the timeline you propose, you give a comment period, you finalize. I think we're getting to the point where it's going to spill past Inauguration Day. I
mean, there's no question that it's impossible at this point. So, and also I will tell you that I have friends still on the inside who have that I have asked about this, and they have told me that the director has publicly said it will be by the end of the year. So that is what I am permitted to say. But
all right, very good. I take that.
That is my understanding. Yeah.
Yeah. So guys, I can't not take advantage of having you here just to give people a little bit more sense of the insights into the CFPB and, what it's like to work with the CFPB. I mean, just my sort of nugget that I like to share with people is that the CFPB, despite its impressive name and power, is still a very, very small agency. And in fact, there are some large national banks who have more compliance officers than there are total number of employees at the CFPB. And so I thought it would be just kind of cool, given that you guys both were senior executives at the CFPB in different areas, one in markets, one in regs, to just get a little insight about, maybe some tips and best practices. And I want to start with Nora first. Maybe you could just give us a sense of, we all these people in the industry, we have to comment on regs. We don't know what makes sense, what doesn't make sense. Any tips? What is reg? What matters? How can they be more effective?
Yes. I love this question, actually, because I, in my time in regs, read so many comment letters, and was often frustrated by what I read and would have wanted them to say something very different. So my advice for comment letters is, comment letters it's not a voting process, right? It's not, I like this rule, I don't like this rule. People seem to want to write in and just say, I hate this rule, period. It will be hard, period. That is not helpful when you're drafting the regulation and you're trying genuinely to respond to the comments. What is helpful is this will not achieve the result that you think it will achieve. And here's why. Because you tell me to do XYZ thing and the result will be this other thing that you haven't thought about. And here's why you should change it. So it needs to be, I would recommend comment letters be very concrete. Have data if you can possibly have data. Here's how much it cost me to run the software that implements this thing. And if you make all of these changes, my software, my costs are going to go up by 50%. And here's why, and that's going to last for this amount of time. Be concrete, share data if you can. It's not a vote. And also, another thing I really like is give me an alternative. If I'm the person writing the regulation and you just say, I hate it, what don't you hate? Do you have an idea of how to achieve that policy objective that the Bureau has said it wants to achieve in a way that doesn't mess up your business model, that doesn't cost you lots of money? it's a lot easier to implement that if you're the writer, if you're the lawyer on the other end of that, if you receive that regulation and someone's proposing an actual alternative instead of just striking down everything you suggest. So be concrete, provide data if you possibly can. Those are my
And Nora, just to follow up on that, I'm just curious. I almost time to think about when you're like arguing in a debate, the notion that I imagine there's some things that might be difficult to persuade a regulator on. There's some things that they might be more open to, just like, for example, information that they're not aware of, right?
Absolutely, yeah.
Impacts that they're not familiar with. All about just expanding their knowledge, right? Because one of the challenges being a regulator is you don't know what's going on in the industry. So I don't know if any other sort of like are there certain topics that are easier to persuade on than others, or don't even worry about it, just give your best shot and be fact driven?
I would say as long as you're fact driven. I don't know that there are topics. I mean, from my perspective, as I was a career staff person who was genuinely just trying to get it right and make sure, maybe I sound like Pollyanna and nobody is going to believe this, but I genuinely just wanted to make sure I got it right. I did the best that I could in achieving the policy objective. I think there are definitely political appointees who aren't going to listen if you say XYZ thing because it's a policy position they disagree with. I think the majority of the people at the Bureau are not that way. They're really just trying to do a good job and get it right. So I don't think there's a topic they're not going to listen on. I think it's just about how do you be persuasive and how, what information can you provide? And the more data, the more facts, the more alternative suggestions to achieve the same result in a better way, I think the more likely you are to persuade most of the people working on those regulations.
And Gary,
Yeah, I would.
Oh, go ahead, Gary.
I was going to say, I like the alternative approaches. I've seen a lot of alternative approaches that the Bureau might not have had the authority to do or other things like that. And so, if the Bureau doesn't take those approaches, there's some reasons and those ones are kind of generally difficult to explain, when the final rule comes out. But I really want to underscore the concept of data from two aspects. One is, if you're a lot of the work that I did at the Bureau, I do work with now, or and I know Nora does well, and Tom's whole company is related to, I think, innovative business practices. Like think about like new credit services that have emerged, like earned wage access, buy now, pay later, point of sale lending, and all these other things. And there's a lot of, I think, natural angst that comes from consumer advocates in the Bureau about like the safety of these things. Are they ready for prime time yet? And I think the best way to pave because I think these innovations are generally good, and but you really have to be analytical. You have to know what's under the hood. And so I think data is a great way of demonstrating the safety of these products. And quite frankly, if you're not looking under the hood of your own product, that's being a little reckless as well. But the other benefit to that is, back to, I think, some of the discussion we had earlier, and to be really cynical, if you're giving the Bureau data and they have it and the rule comes out that seems to ignore that, that just pads the way for you to challenge that rule later because they've ignored facts. So it kind of calls it out to let's, be very transparent about what we're doing here.
I will add to that just because I have realized now in private practice, when I have these clients, I'm often, hired to write comment letters for clients. And I ask them to provide some data so that we can put the data in the comment letter, and they never want to because they're afraid of giving that data to the CFPB because they don't, they think, oh, well, they're going to come after me in an enforcement action, or they're going to use it in some way that I'm not anticipating. I do understand that. I do understand that concern. And now I'm realizing on this side why we didn't get as much data as I would have liked when I was at the CFPB. But I still think, to bring it full circle back to the sort of point I made very early on, the Bureau is not as omnipotent as you think it is. So just because you give the data in the rulemaking, it's, there is not some person on the back end who's immediately waiting to transfer that to enforcement and, have them bring an enforcement action on it. It's really not the way it works. So I would encourage people not to be afraid of providing data.
I did want to focus on this concept of engaging with the Bureau and
Yeah.
how to engage with the Bureau. And Gary, you are an expert. You were in markets. You were off of the interface. And Nora in regs as well. And so one of the questions I often experience from the outside is, should I stay or should I go? Should I engage with the Bureau or should I run as far away and be, especially with fintechs and startups, there's a lot of folks, they'll never even hear about me. They'll never know about me. So I guess one question I would have for you, starting with Gary, but also for you, Nora, is should I hide or how do I engage with the Bureau and should I engage with the Bureau? What's your view as somebody?
I think some of it really depends upon the threat to the sustainability of your business model. We saw early on companies that immediately wanted to establish rapport and discussion, and others it was kind of like, not without a search warrant, or am I giving you anything? I think, again, in the innovative markets, you're doing things, unless you're really a fraudster trying to scam consumers, you're trying to do things to give consumers a better life, which is kind of the mission of the Bureau. And so if you're doing something that's out of the box, I think it's generally good for your regulator to be informed so that they don't inadvertently cut off access to something that could be good for consumers. And then also, at the CFPB, we used to say, we're the ones that are paid to think about what happens when things go wrong. And I've seen a lot of really interesting solutions in the marketplace, but the Bureau then says, but what if this happens? What if this fails? What if that fails? And I think getting that perspective from the Bureaus only helps you to make your product stronger. So I'm pretty pro engagement generally.
Same. I think there's very few, there are downsides, right? But I think the downsides, as Gary mentioned, and maybe I'm naive on this, tend to be for the sort of bad actors, right? The ones who are trying to take advantage of consumers. I think if you are genuinely, believe in your product and your product is designed to fill some need and, in a way that is fair, I don't see a huge downside to engaging.
Well, the only downside I think would be cost and bandwidth, in which case, do you have a trade association or there are other frenemies in the marketplace that you trust to speak for you? That's the question. But
in my experience, the Bureau is really, especially, the career staff, they're really just trying to get it right. They're trying to understand the product. They're trying, I recently represented a client where we wrote a paper on a topic that the Bureau had, there had been a lot of discussion about, and we researched paper, we wrote the data, we had a meeting with the CFPB, we presented this data to them, they asked a lot of questions, they seemed very interested, and then they put out some guidance that, seemed to incorporate the data that we had provided them, right? Like that's how I think it should work, and it was very successful. So I absolutely think that if you engage correctly with the Bureau, if you provide the data, if you answer the questions they care about, if you know what they're looking for, it can be very helpful.
And just to add that, this is my own perspective on this, which is that I think if you build credibility with the agency by providing information, by being trustworthy, I think you get a level of trust. And not that you're going to get any special treatment, but people are going to ask. I think that at the end of the day, it gives you a reservoir of goodwill that you can draw upon at different times that might help you. And so just from a purely, interrelationship, it's one thing knocking the door with a stranger and another walking the door with somebody that you've had an ongoing relationship with. So with that, I just want to thank you both for extraordinary conversation. And thank you again, listeners. Just remember, stay informed. I'm Tom Oscherwitz, your co-host.
Thanks, Tom. This was fun.
Yeah, thanks.